Welcome to my channel. I'm Dr. Romano. In today's video, we are going to be discussing why is it that investment banks keep failing us. I will walk you through my reasoning and my understanding as to how they could also improve those companies. Before we continue the video, please remember to subscribe to my channel. Do thumbs up. It's right there. It doesn't hurt to press it, but that will really help me out. Thank you so much. As you know, I'm Dr. Hedge Fund for a reason, because I have a PhD in financial management and leadership. I have an MBA in financial management and also another in risk management insurance. I also worked for the investment bank in a group called Risk Management for the Chief Financial Office. And my particular job was a very important job, and it was to review the trading books before the chief financial officer would review them, and then of course approve them. Risk management would base their reports on that information. And that was one of my first jobs away from the family, and it also led me to complete a PhD 9 years later. It also led me to create my PhD, and that's how I came up with what I wanted to be a doctor of, my specialization, etc. I perfected over 8 years or 9 years the investment selection process on hedge funds. I also improved hedge fund selection and came up with my own theory. This has a lot to do with our banking system and how they trade capital and how they invest capital. Because with the investment banks, you can have one or two desks that basically bring down the company. And this is very scary. And this is a reason why they need to change their structure, because instead of hiring traders who have a track record of 5 to 10 years, they don't do that. They first recruit them from Ivy League schools. There's only a handful. And then from there, you become an assistant trader. And from there, you become a trader after 2 to 3 years. So that means they're giving millions of dollars to people in their early 20s to trade capital. And it is highly unlikely that these people, these young traders, are in their 30s or 40s. Because someone who is recruited from an Ivy League school, what age would that be? And so you have to think about. They're in their early 20s, and by the time they reach their 25, they're already a trader. And then by the time they are 30 or 35, they're gone, because the investment bank is not going to keep people that long, because they have to pay them too much money every year. Or possibly this person goes to another investment bank and they go from door to door to door to try to make a little more money. This is why over a 20-year period, since the year 2000, the hedge funds have grown to what they are today. And this is just the beginning to what they are going to be growing to. You're going to see a lot more hedge funds out there, and a lot more hedge funds able to raise capital. Because you have to remember, 10 years ago, 20 years ago, it was very hard for someone that's starting out trading and to raise capital to create an actual hedge fund. But today, you're going to see a lot of diversification, because again, in 2008, we saw the collapse of the investment banks. The hedge funds started to grow even more. But now, this second collapse that's happening, people realize that they shouldn't be focusing on putting their money in investment banks. And I'm talking about those big investors. There's no reason why a large endowment or someone that's a billionaire should be going directly to the investment bank to put up assets, to invest capital. They should be going into directly where that capital is being allocated. And that's the hedge funds. But you still have traders at investment banks trading capital, and that's where the problem is. You recently, over the past, I would say 8 years or so, about 8 years, 7 years, you had a lot of money being poured into cryptocurrency. Was that a good idea? Well, I didn't think it was a good idea because I was actually trying to raise capital at the investment bank, and they interviewed me and we had a meeting, and unfortunately they decided to go with the cryptocurrency funds of funds. Now the problem is that I would not have been able to create a funds of funds of the cryptocurrency markets, or even include hedge funds that trade that kind of capital, because it was such a new market and I need at least 8 to 10 years to analyze. I will not invest any type of capital in a new market. It has to collapse first, and then once that collapse happens, such as the cryptocurrency collapse, then you could analyze that data 2 to 3 years after the collapse to see how it happened and to see what happened after the collapse. So now I will start to write another book about that, how to analyze that data, how to improve it, etc. for funds of funds. Because it took me a while to also analyze the previous collapse in the equities market in 08-010 era. And so my second book was about that. It hasn't been published yet, but I'm almost done. I need to finish the editing. You have a great change that's happening now. A lot of money is going to be poured out of the investment banking industry, the bank particularly, and because of that change that's going to happen, of course, yes, after the collapse happens, you have investors that run in and buy up those shares and reposition the company. But you also have something that's going to change our markets, and that's the savings bond. Because of the treasury market, the interest going up so much, investment banks can offer a newer product to their clients. It's going to be a fixed investment, such as what we had in the early 80s and 70s. Because you had interest rates so high, they were able to offer that type of product, and it is going to affect hedge funds and those type of traders who aren't doing the 20% or 10% return per year average. Those hedge funds that are producing 6-7% average, well, that's actually really bad. And that's going to affect a lot of things, because why can't the typical person invest in the treasury market? Of course, you have to be very careful because you don't know what you're doing. You don't have experience doing that, and you haven't studied collapses and changes. What happens when the interest rates start to finally go down officially, and you start to see that trend that goes down? But that's not going to happen. That's going to be a couple of years minimum for that trend to start happening again, because you have the treasury market, you have other countries pulling out of our treasuries. The federal government has to go in there and buy up those assets to be the buyer of last resort, as they agreed on recently, and they passed that law. And so they're going to have to print a lot of money to become the buyer of last resort. But that's okay, because that's how our economy and our government works. And so where there's always a loss, you always have a gain in some type of market. For example, the commodities market right now is doing phenomenal, very good. I don't see the commodities market coming down within 2 to 3 years. It's going to take probably 2 to 3 years for it to start to, relieve itself. But it could even stay higher and go higher. Who knows? I'll make a video on that. But as for the investment banks, you have to think to yourself, how could they improve this management style? Because when you have top-down management determining which area that's going to invest and which area they're going to close, that's the problem. And what if an investment bank separated the company to multiple different companies? Not where you have one CEO managing every little area and determining what they're going to do, yes or no, with directors. No. What if the investment bank invested in multiple different companies? Well, you have high quality of management. Because you're not going to have people, employees, moving from company to company. Two, another thing that has to change is the people's pensions. And I don't think this is ever going to change, because when you have employees moving from company to company, they take their pension with them, meaning their retirement. And of course, the company is less likely to fire you because they have to pay out your pension if they keep you. You have companies that are more likely to hire and fire people because they don't have to keep you, because they don't have to pay out your pension because they already have every single year and every single month. So the change, it's not possible to keep the quality of management steady because they just keep moving from company to company. And so when you move from company to company as an employee, you really don't care about the company. You aren't really learning and improving what the company does. You're just managing the day-to-day responsibilities. And you're just holding off until your next gig after 2.5 years on average, according to the Book of Occupational Titles. And it's likely to stay at the company 5 years. It's very tough. So investment banks and banks can improve their quality by, one, really looking at who they're hiring and promoting. You don't hire and basically improve those people that they're hiring and they're promoting as the dominant quality person. And what does a dominant person do? The only thing they're good at is really getting rid of their competition. Unfortunately, that's how it is in this world. The ones that are dominant, the ones that put down everyone, and they always stick with the high people up at the company, they're promoting the wrong person. They're going to promote the dominant person that's putting down everybody. And this is a big problem in corporate America, because all the people that have quality, they leave the company or they don't get promoted. So in other words, have you ever wondered why you put so much effort in your job, but yet you didn't get the promotion or you got fired? That's why. Secondly, in this past decade and 20-year cycle, you have a lot of people that are getting hard and that are promoted that think with an emotional way of being, and they're making decisions based on being emotional, having that emotional personality. That's a big problem. You don't make decisions based on your emotions. You base your decisions based on your economic understanding and your management understanding. And that's who's getting promoted today. So that's why now we have another collapse, because the company really doesn't care about your capital, particularly investment banks, etc. Two, it has nothing to do with how much their capital they're supposed to keep in case of a crisis. No, it has to do with the fact that a lot of companies invest in cryptocurrency, and because they gave a lot of capital, they allocated a lot of capital to a very young society who didn't know or ever experienced a cryptocurrency collapse. Well, that's one of the main reasons what's happening now. And that's why you keep seeing the equity funds of funds, the equity hedge funds grow to what they are, and they're going to keep growing. There's going to be a lot more hedge funds that start today for over the next 5-year period, because the capital is being allocated elsewhere. And that's another reason why we have these collapses. Because back then, in the 80s prior, you had more of an older, mature group of people managing the capital at the banks. And these people had a 20, 30-year track record, and they understood every time what happened when there was a collapse. So they had experience dealing with this. They didn't just have experience with management. That's not talent, just because you have management experience for 10 to 20 years. No. You have to understand economy. You have to understand the economy as a whole, micro, macro. You have to understand finance. Just because you have a dominant quality and you're telling everyone what to do, that's not quality. And so I want to thank you so much for watching my video. Please remember to subscribe to my channel. Please remember to subscribe to my channel, and please do thumbs up. Thank you so much.